All right, good morning, everybody. So we're still reacting to all the changes in behavior or changes in sentiment, I guess would be another way to say it. 5 to 7% is a standard pullback in a typical buy the dip marketplace, but we've been sideways for a while, just chopping in the range. Same old at this point. Japan down like yesterday, more than 2.5%. NASDAQ and the S&P basically flat, small caps on the green side, but flat. And the Dow working for an upside move, not yet at 0.25%. Hong Kong up 0.5%. Seeing a lot of posts out of Germany this morning. I mean, it's been really bad over there, and it doesn't look like anything's changing anytime soon. But it is what we're seeing a lot of talk of this morning. We got a lot of Fed speakers, got some auctions in the front end, but at this point, really all eyes on NVIDIA earnings. There has been times when NVIDIA is going to do earnings where we go in this sideways hurry up and wait mode. I don't think we're really going to see that this time. We've just got too much going on the backside, and I don't think that there's enough trust in what NVIDIA can provide for its earnings release. Bitcoin dropped through 88 last night. So if we consider Bitcoin an example or a representation of risk, then we're certainly seeing a change in market sentiment where people don't want the risk. There's a whole lot going on right now we need to be concerned with, like the 10-year with this exaggerated move to the downside. We've been looking for the 10-year to go down. We've been looking for the dollar to go down. But going down for the right reasons and then in a controlled manner. This is a little bit out of control on the one hand, and it signals that things could get pretty ugly pretty fast. So, know your lock limits and keep your eye on the news through the day. At this point, we're looking for the dollar to get below 106, and then we'll work on 105.5, one step at a time. We don't want the dollar to start doing what the 10 years done, right? We don't want this exaggerated move. Just these nice, clean stair steps down, that's a lot better, right? You kind of look at the ES and the 10-year, those extreme swift moves, it's never good for the market. Doesn't really matter what the product is. You don't want those kind of moves. So we're below the 10-week, the 10-day, the 20-day, right? All the levels. We still got some major moving averages below, but the 10 is kind of the big one to keep track of. Elevated volumes sitting at 137 in the overnight. So they're in here participating. They're not hedging it out. And I mean, they're getting their work done. Five to 7%, right? That's the norm. Now, it doesn't have to be a perfect 5 to 7%. It can overshoot and get into 9. I mean, we can even get into 11. It's the idea that we're still not looking at a bear market, right? That we would end up flipping it around at some point and working our way back up. But just like we did the last time on this last dump down through December, just because we turn it around and run it back up doesn't mean we're going to break out and continue to go higher. And I've been saying this since December. We can sit in this range and chop here for half a year or more. It doesn't owe us a breakout and a run farther to the upside. On the other end, it doesn't really make sense to see us just completely break down below 5,800 and wash it out either, because we're not in a bear market. We're just in a market with so much uncertainty that it's hard to see capital inflows continuing to come in, which the news has started to point out the flows are turning around. $59.15 is the put wall to the downside. Then we've got zero gamma and volatility trigger overhead, 60.50 and 60, call it 60.70. And a call wall, 62.16. Keep your eye on that call wall. See if it gets rolled over the next day or two. It would make sense to see that brought down. It would also be a really bearish signal if they do bring it down. As long as they still hold it up there, then they still intonate that they're willing to run it back up. They start walking that call wall down, well, seems like they gave up on the idea of running it back up, at least for this expiration. Since we are in a negative gamma environment, markets can make more exaggerated moves. If we break out to the downside, dealers will sell into selling. And if we break out to the upside, they can buy into buying. It's not that they will, they can. We have to consider their position and the activities that they'll take to remain delta neutral. We assume once we're in a negative gamma environment that they have to take these actions to remain neutral, but we don't know where their neutral spot is. So like yesterday when we started running to the upside, I had somebody reach out talking about, hey, is this where they're going to start buying? Are they buying, adding to the buying? I would say no. We hadn't broke out at that point, right? We hadn't really gone anywhere. We were still within the range of what they were already working with. But we don't know, right? Does it need to get all the way up here and then break out before they start buying? We don't know where their neutral position is. It's just the intraday GEX levels would be more accurate at that point. If you have something like spot gamma where you can use the trace or the hero, probably the trace, so that you could see it. We're closer to the lower edge. Well, we were. But we've already started to run back up and now we're basically flat. So we're close to where we closed last night. Generally, if we get close to one edge, one of these red lines, the expectation is we'll just go ahead and hit it. But we did get close to it and we pulled away from it, started moving back the other way. This is an inside day breakout and we came back in again after breaking out. Now we did that earlier too. We broke out, came back in. We weren't able to keep it. We broke down again. And now we're back inside the box. But with an inside day breakout, once you come back in, you really need to keep it. It's the recovery. Just think about yesterday when we got back inside of Friday's range. That was great. It was a good recovery. Really needed to keep that, and we didn't. So that's when things really started to get ugly in the later part yesterday afternoon, is once we weren't able to hold the line anymore, it became clear that we need to hold that. That's what we should do if things are good and healthy. And we weren't going to keep it, and then it just washed. Careful this morning on the same logic. This is the second time we've came back inside of Monday's range today. It really needs to hold the line here. Unfortunately, what we're seeing is lower highs and lower lows, and it's likely that we don't hold the line. So breaking 59.70 offers us 59.32 cog line down here. Below that, we would look for a market maker move. See if they come in and start adding some hedges within the options chain itself. Otherwise, the other thing that you can do is just look at your average daily range and give it another level. So you got this distance here. 5,900 would be your next level. We've got 59.92 cog line. Which is just outside of yesterday's low. And that's it. Then we've got our own little structure here this morning. Then we start working on those ADRs. So far, we have an MDP. That's a missed daily pivot. Generally, markets hit that pivot about 80% of the time. So another way you could say it is we have an 80% chance of hitting this line today. That's 60.22. And we hit that line yesterday. That's all we were able to do with it, is hit it. And depending on what platform you use on TradingView, this line was just a little bit lower, and the ES was pressing against it with all of these candles. Now on Thinkorswim, we only hit it once, but on TradingView, the formula must be just a little bit different because the line was more like in that spot there. So it doesn't really matter, right? Either way, these channels provide insight on, it's just a math formula. The math formula derived from yesterday's price, same as with the floor pivot itself. How wide the channel is, where the floor pivot is in relation to yesterday, and then where price is at. Today's floor pivot opened below yesterday's, that's bearish. Price opened underneath it, and that's bearish. We rejected against the channel a lot like we did yesterday, and so far we haven't been able to get through that channel. If we can get through it, then we can tag that floor pivot like we did yesterday. That would at least eliminate the missed daily pivot. But getting through it and above it, we've got to get through 60.32 cog line. And it's the same level from back here. Now we've put in a lot of work just above that right here. Today's channel is narrower than yesterday's channel, but it's still pretty wide, all things considered, which implies if we break out, it likely doesn't stick. Remember, that's what we said yesterday, and we broke out with this really wide channel, and it didn't stick. The breakout didn't hold. We came back in again. Now, sure, we went back out, but these channels don't make price move, right? They don't make it do anything. It just gives us insight on what to expect if we break out or if we don't break out. We don't have a lot of help from the profile yet this morning. This is a profile on the week, and right now it's just really wide with a lot of volume. I think that's the one thing that stood out to me when I was looking at this earlier, is just how much volume there is across this whole thing. It's not like it was concentrated at a certain spot. That's a lot. So it'd be good to get some more clarity with this. I'll be digging through it today. These are the March contracts, and we're getting close to when we're going to be swapping these out. So open interest is already fading. We're seeing their positioning shift. I'll do some more digging on it, but that was a lot of distribution through the whole range. So no real insight there if we're looking for a classic profile or any help with point of control, value areas, any of that. Ten-day, 30-minute volume profile. Not expecting anything to change here. We've got days before we even get to these candles, almost a week, before we start eliminating the volume that moved the profile with the point of control up into that 6132 area. So the only thing that's going to move it now is if we can get more volume than this up here at a lower level. That would mean that we need to stop moving around and stay in one spot and build it up. Now we can see that maybe after NVIDIA, or maybe tomorrow while we're waiting on NVIDIA. We could just stay in one spot and chop, but there was a NVIDIA earnings on a Wednesday, a couple of quarters back, and Monday, Tuesday, Wednesday, we didn't do anything. We just stayed sideways in like a 40-point range, and we did nothing. Yeah, that's not this, right? We've been moving like crazy. There's no expectation we're going to stop at this point. Maybe tomorrow by 9:30, we start going sideways as we get really close to the earnings, but not yet. So if we're not going to sit tight, then we can't expect that we're going to stay in one spot long enough to build the volume up enough to move this point of control. We hit the VPOC from Friday. That's going to give us a new one, though, for today from Monday. So a break to the upside, if we can get through 6011 cog line, which happens to be this morning's point of control. Then we've got 6032 cog line, which is the point of control from yesterday. I talk about these cog lines all the time, and I mean, I get it. I get asked about them. They're not very common. But have you noticed at this point how often point of control or yesterday's high or yesterday's low seems to line up on one of those three: 11, 32, 92. They come up again and again and again and again. They're just really important levels, right? So 6032, if we can get a breakout through our own Globex high, we'll go after that level. 59.38 is the lower edge of the weekly expected move. If we break down again today, it's very likely we'll reach the edge by the end of the day. This is how far we're supposed to travel for the whole week, but there's plenty of examples where we make the entire move in one day. Back below the 10-week at 0.25%, it's not much yet. We can see that every time we've been below it over the last year, we went more than 1% to the downside. So 1.25%, 1.5%, sometimes more than 2%. And that's just in the last year. Of course, if we look out farther, kind of spread that into a couple of years, we've gone deeper than that. But when it comes to the weekly and going below on the weekly, it's rare that we just go to 0.5%. Here's one where we did just 0.5. Every other time we've done it, we've gone a lot more. So we've been looking for a 5 to 7% pullback, and our distance below the 10 says it can give us more downside, another 0.5%, maybe even a 1% move more to the downside below the 10-week. Looking at the 10-day, we're more than 1%. Looking back, we're about at the mid. Now this one is different. We've spent a lot of time, where we don't even go 1/4 or 0.5% below the 10-day. And then we just run right back up again, because in a good, healthy market, right, we just drop down to the 10-day, get a little bounce on it, find some structure, and run up to another level. At this point, even in the short term, we're not oversold. I don't even want to approach it with that sort of language, because it gives people the wrong idea. Oversold kind of implying that it's been sold too much and maybe we should be buying at this point. Just the language itself confuses newer traders. But we haven't sold off far enough that would make us mean revert or look for some reflexive bounce to the upside, because our distance from the 10 at this point this morning is right about where we were on the 21st. So on Friday, on yesterday, and this morning, they're all about the same. So even after that big drop and the continued move to the downside, our distance from the 10 about the same. If we had another 2 days like we had on Friday, then sure, we'd be looking for some sort of mean reversion or a bounce or a least squared methods move back in the other direction. We don't have that. And it doesn't owe us that. Defensives are still looking good. XLP and XLV, it's staples and healthcare. Utilities are basically flat, but they have been tied into the AI sort of, the whole energy for data center enough now that even when we consider data, technology, consumer discretionary, riskier assets, utilities are getting lumped in there with the group because of that. So sure, they're usually defensive, but we can see they're not being treated like a defensive compared to healthcare and staples. So we're getting a short-term capital rotation into defensive names. If you're looking for a tell that that things are getting really bad, keep your eye on the defensives, because at some point they'll start washing those out too, right? And it won't be a rotation back into tech or back into financials or into the riskier assets or the risk assets. It'll just be dumping out of these too. And we're seeing them bid up the bonds. That'd be another one to keep your eye on. A violent move in the other direction in bonds. So bonds to the downside, yields up. That'd be another warning that that all of this is changing back around again. Over a 5-day period, Bitcoin is basically flat here. Otherwise, we're down 5% this morning in Bitcoin, gold 1%. And really, those are the two that are down, Bitcoin and precious metals. To the upside, we've got China, bonds, and that's it. So it's a very select group, up and down. Everything else is just chopping and waiting. Now, utilities is almost there. XLU, it's at 0.48. We use 0.5, so it's really close. Maybe it's close enough. We're seeing a little bit of flows, not just an algo print, but actually getting some flows there. Needs to follow through. It has that big candle like I was talking about yesterday, how most stocks were going to have that big candle. Got to get through the midpoint of that candle and then get to the top of it one step at a time. And then XRT is right behind that, 0.48. Right, so we got retail, utilities. Both of those are lumped in with safe haven assets anyways. I mean, they're not staples, but they're certainly not flashy spending consumer discretionary stuff. What we don't have is the Mag 7 communications, technology, consumer discretionary. We need those if we're going to get a move to the upside. Now, we've seen some big moves in gold and in silver, so it makes sense that they're down a little bit now. But gold and silver are precious metals. They're supposed to be a safety haven, and they're supposed to be where money goes in times of threats or risk. When we see those down, and this isn't the case here, but it's what we want to be focused on, is banks getting a margin call. If they got to cover their margin, they'll sell gold to do it, like a global margin call. That isn't the case at this point, but it isn't good that it's already to the downside, because then it makes it harder to spot if they are getting into a crisis and they're getting a global margin call. We just had a really good run, right? And it needs to digest. It's not a surprise that it's pulled back some. And lower crude is supposed to be a good thing, just like a lower dollar and a lower 10-year. All three of those, the market should be popping to the upside and, smiley faces and rainbows and everybody happy. Energy down, 10-year down, dollar down. That's fantastic. And yet we're selling off. We're barely holding the line in the S&P and the NASDAQ. So it's not a time to, change out a lot of things in your portfolio. It's not a time to be shopping around for new trades. We don't know where we're headed yet, and things are way out of whack. So just proceed with caution. At this point, I would be looking to hold the line, maybe try to claw back some of what we gave away yesterday and in the overnight last night. And we're looking for a market to change the narrative after NVIDIA. And it's not just NVIDIA this week. We have economic data this week too. But we got to change the narrative around. And we need clarity and some guidance. If we break down below our own low that we've set, then target that 59.50 and then 5900 and just continue to, keep your eye on the prize. That 5 to 7% pullback, getting back down to 5800. That gets us down to around a 6% move to the downside. It's not perfect, but it doesn't need to be. Any move today to the upside, it's going to have to come from options flows or the Mag 7 stepping in, a change in the dollar, bonds, yields, oil. Maybe some news. Otherwise, look to just hold the line, keep the low that we've put in without getting any worse. Kind of like yesterday, once we set the low, that was it. It didn't get any worse until, the market closed and we went into the Globex. Try to just hold the line. So what I got for you guys, be careful, be safe. See y'all tomorrow.